Hello and welcome, everyone. Thank you for taking the time to join us today for quarterly StoneX Global Macro presented by Vincent Deluard. My name is Maria Mbet. I'm Director of Institutional Sales and Trading here at StoneX. I'll be moderating today's discussion, but before we begin, we'll go over some housekeeping rules. At the bottom of your screen, there are several engagement tool icons. You can open and close throughout the session, and all the engagement tools are resizable and movable. You can expand the slide area, maximize it to full screen by clicking on the arrows on the top right center. If you have any questions during the webcast, you can submit them through the Q&A engagement tool found at the bottom of your screen. Questions will be answered throughout the presentation, and by the end of it, should any questions go unanswered, please reach out to the presenters or anyone on our StoneX team. You will also see the resource list where you can download content that we will cover throughout the presentation. The session is being recorded and will be available on demand. An email will be sent out in the coming week on how to access it. So now I'll pass it over to Vincent Deluard, our global macro strategy, to start today's discussion. Vincent, over to you.
Thanks, Maria. Hi, everyone, and thank you for taking time from finally a busy day in market and some of these correction action I've been calling for. So the title of today's presentation is the trampoline lending. This used to be a joke I made earlier this year when people asked me, what landing do you expect? A soft landing, a hard landing, a recession landing? And I would joke, no, I expect a trampoline landing because I didn't see the economy slow down. I actually saw the economy was, by some measure, reaccelerating. Well, obviously, we are experiencing this trampoline landing today with the jobs data was one more indication. But unfortunately, with trampolines, you bounce back, you go back up, and at some point you reach the top, and then that's where your velocity starts to drop, and you start to fall again. I worry that's precisely where we are in October. So the first part will be about why we did not get the recession that so many supposedly smart economists who basically all looked at the yield curve, were forecasting in their 2023 outlooks. So I'll go from the indicators that I was following that kept me on the right track of that debate. The second idea would be the idea that we are on the top of the trampoline bounce, and that we're going to slow specifically. Actually, it's a full punch combo for October now with the rate shock. I worry that growth is going to take a hit from there on. And then we'll talk a little bit about my outlook for inflation, which remains that maybe that 3% print was the low. And then we'll go over the investment implication, which is the view that I think growth slows in the U.S., but maybe we avoid a nasty recession. And when that's the case, when you want to be in the U.S. when either things are great, like they were earlier this year, like everybody wanted to buy NVIDIA and Microsoft or Tesla, or when things are horrible because still the cleanest dirty shirt out there. My view is that next year is going to be somewhere in the middle, which will give way to outperformance by international assets, something that actually we've been seeing outside of China already. So those who follow my work know that I don't waste time on GDP. I believe GDP was invented to create jobs for PhD in economics that would otherwise be serving lattes at Starbucks. You don't know what GDP is until it's been revised 10 times. So what's the point? If you want to know how an economy is doing, you look at how much money is being paid in taxes. And in the US, you can see that on a daily basis in a report called the Daily Treasury Statement. So I watch that pretty much every day. And so far this year, withheld employment tax collections, so the ones that are paid on people's primary job, the W-2s, are up 1%. Now you think 1% is pretty awful, right? I mean, wow, we're already slowed down. Well, you have to keep in mind that the brackets have been increased. So last year we had very high inflation. And when the IRS revised its bracket, it used that high inflation number to increase the bracket so that people wouldn't fall into a higher bracket because of the high inflation. So the brackets have been increased by 7.5%. So that 1% is on top of 7.5%. So that's almost high single digit growth in nominal income, which tells you of an economy that's doing quite fine. Maybe not as rapidly as last year, but still, some of the best growth since Ronald Reagan, at least in nominal term. That inflation adjustment mechanism is also going on with Social Security. So around this time, usually Social Security Administration announces something called the cost of living adjustment to compensate basically retirees for inflation. Last year, that was 8.5%, and that started January 2023. So January 2023, you have about 70 million Americans on Social Security getting an average of $2,000. Boom, they get almost a 10% increase. Now, keep in mind that these are like, small people, like middle class, working class. They don't need to save for home. So if they have more money, it would go in restaurant, cruises, shopping, whatever. It's high velocity money. It's not like QE where you kind of hope by making the billionaire trillionaires somehow they'll spend and that will, drip down. This is very high velocity money. So you get the income tax bracket effect. Then you have the inflation adjustment. Then, of course, we had the gush of spending from the Inflation Reduction Act and the CHIPS Act. You've seen all these fabs being opened in Texas, Ohio, New Mexico. I estimate there's about $140 billion in fiscal spending right there. Then we also had rate hikes. And when the Fed hikes rates, what really happens from an accounting perspective is that it starts printing more money, all else equal. When you go from 0 to 5% and you pay, that's what you pay on bank reserves and the RRP. And you have about 6 trillion in between the RRP and bank reserves. So as you hike rate from 0, 6% times 5 trillion is about $300 billion that you have to credit every year on the accounts of the people who have an account at the Fed. So you actually create money. And this is pure money creation. This is not like QE where you swap an asset for another. No, you just make money out of thin air, credit bank reserves. So that's 300 billion there. And of course, you also have a greater cost of servicing the debt. The interest expense from the US Treasury has risen by 260 billion, and it's going to rise fast as we roll over more of the debt at the higher rate. So you add all of this, and I found that we have about $1 trillion in stimulus in 2023, which is why I thought there was not going to be a recession, because if you stimulate the economy by $1 trillion, it's going to go. And indeed, that's more or less what you see. If you look at the trajectory of the deficit compared to what the CBO had, we're about 800 billion higher this year than we would have been last year. So, you can break it down. You can see it here by main expense categories. Federal salaries are up 7.5%, because, civil servants, they work hard too. Social Security benefits up 16%. So part of it is that cost of living. Part of it is the growth in the population of retirees, and then interest payment up 36%. So if you had to summarize Bidenomics, that's it. It's nothing special. Good old Keynesianism, run the deficit and then a sprinkle of modern monetary theory for the Fed's balance sheet. And yeah, it works. Fiscal works. I think that's something we forgot. We've been over-reliant on monetary policy for a long time. We've been obsessed with central bankers, but we forgot that the simplest way to make an economy work is to pay a bunch of people to, dig holes and fill them up at night. So this is showing up in the private sector. So when people are asking me, when do you see a recession, I always look at the construction sector, because typically employment in the construction sector leads general employment by about 6 to 12 months. And if you look at jobs in the construction sector, it's actually grown by 200,000 in the past year. The exact opposite. 2007, you could already see that fall down. Now it's still growing. Now, why is it still growing? Well, mostly it's because there's an offset between residential, which is indeed slowing now, especially after the shock, and non-residential, where we are seeing a boost in infrastructure. Basically, companies and government spending like crazy, the fabs, the solar panel, the grid. So construction employment remains very strong. Another factor that I think was kind of scary earlier this year was tech. I live in San Francisco, so pretty much every conversation was about the tech layoffs. It's gone. Like, I haven't seen a single tech company announce a big layoff program in the past 6 months. And that's because, AI, right? I mean, everybody's, the people who got fired as product managers, who were the ones who were doing TikTok videos a year ago are now AI prompt engineer making twice as much. Doesn't matter from the perspective of tech companies because they paid in stock and the stock price is back up. So, right now it's, and then you see that, I think, again, in the jobs data today, I think you saw the white collar jobs were actually quite strong. Other cyclical indicator I monitor are remittances from Mexican workers. I like these guys because they tend to work in the most cyclical industries, service, construction, and they tend to be the first to be let go. Last quarter, that was $15 billion that they sent back to Mexico, which I think, by the way, is one reason for the rise of the super peso. That's something I'm writing about today for those who are subscribers to the research, look at the super. But anyway, the fact that you have remittances up 10%, which is a bit slower than last year, that was 20%, tells you that, the kind of blue collar job market is fine. You can see even this kind of spike in activity globally. July 6th was the most painless high. And I know it's anecdotal, but I was reading about how the Taylor Swift and Beyonce tour added 0.5% of GDP growth this summer. Or the Barbenheimer, you really see an appetite for, traveling, experiencing, and, regardless of prices, people are not happy about the high prices, but they still paying, even in Europe, where we have a recession, but still the, best tourism season in Greece, best since 2019 in France. So yeah, things are looking so good that even real economists are starting to see it. If you look at official data on personal income, it's growing at about 7%, while inflation supposedly is at 3%. So you have real wage gains. And then, of course, this is the Atlanta Fed that I now printed and framed above my bed with the trampoline lending, 5% real growth in Q3. Very few economists had that on their bingo cards this year. Now, my problem with this is that for the same reason that I was bullish on growth in 2023, I'm worried about 2024. It's the inflation story. Basically, in 2023, we were coming out of high inflation, it was falling. So all your adjustment reflected at an embedded high inflation rate, which didn't turn out. So that was real gains. 2024 is going to be the opposite because we're doing the benchmarking of 3% inflation. So cost of living adjustment is going to be raised by 3%. Now, if I'm right, inflation is going to be about 4.5% next year. So instead of having a 5% real income gain for your retiree, you're going to have a 1 to 2% drop in real income. Same story with the income tax bracket. So that's going to give a hit starting in January. Something else is also happening behind the curtain is a change in state spending. I'm a big believer in looking at state. The U.S. is a federal country, and all your infrastructure spending, or at least 75% of it, comes from states. Now, I picked 4 states, 2 of which the governor is waiting for Joe Biden to die, and 2 of which the governor is waiting for Donald Trump to go to jail. For the record, I would support both propositions. I'd be very happy if we had something else on Biden v. Trump. But anyway, in both cases, the governors have done the exact same thing. They pulled spending in 2023. We had huge pay raises in Florida for teachers and civil servants, as Ron DeSantis wants to run on the Floridian model and the Floridian miracle. California, we had a huge surplus in 2022, and as a result, I even got a debit card with $500 on it from Gavin Newsom, who is clearly thinking that, should anything happen to Joe Biden, he's ready to step in. Now, the point is what they spent in 2023, they won't have in 2024. So we'll see a cliff in state spending in 2024 from 2023. So that's another reason why I expect growth to slow down next year. Less fiscal impulse. On the rate side, I'm less worried. You see all these kind of doomer stories on Bloomberg about people working 4 jobs to pay the credit card and blah blah blah. It's we have $1 trillion in credit card debt, which is higher, but it came from a low level, 700 billion. What really matters though is that interest on that debt went from 15% to 22% now. So that's about $50 billion in extra interest payment. Again, I don't think it's systemic in itself, but it's $50 billion. I mean, some people are going to feel the squeeze for sure. And the higher rates stay, the more this debt kind of resets at higher level. So there is an argument to be made that the longer we stay at 5.5% rate, the more restrictive policy becomes because debt resets. Another part of that October 4-punch combo is the resumption of interest payment on student loans. So I typically look at this from the daily treasury statement. I look at Department of Education. Typically, money leaves the Department of Education. There is no receipts, but then the receipts actually spiked. Last week, we saw $1 billion come in every day. Now, what was that? That was people paying back their student loans ahead of the resumption of interest payments. So I think that validates my view that the consumer is in fine shape. Most people who have credit card, huge student loans, the big balances, they are, lawyers, MBAs, doctors. So they're fine. They can pay. I don't think we're going to have like a subprime of student loans or whatever, especially because all the low-income guys are other programs. But the point is, this was money that was in the system. It was probably in bank reserves or it was somewhere in money market fund, and that's being pulled out. So it's a pool on liquidity that's going to hit in October. Another pool on liquidity will come from California. Because we had bad weather and because Gavin Newsom wants to be president, I think, we pulled out the filing dates for taxes. So yes, for non-Americans, yes, it rained in California this summer, so we didn't have to file our taxes on April 15. We're allowed to do it on October 15. That's a bit odd. But the point is now people are paying the taxes, and you see it in the tax collection data. So your deficit is kind of shrinking because, for about 6 months, California, I think Georgia and Alabama were in a similar situation due to hurricanes, didn't have to pay taxes. And now you have to pay it. So again, drain on liquidity, less deficit, less impulse. That's happening in October as well. Now, of course, what we're seeing in October on top of that is an unfortunate OPEC, Saudi Arabia, Russia reality that are trying to squeeze the oil market at a time when we emptied the SPR and when shale is really not picking up the slack. So you see OPEC gaining pricing power and gasoline prices, California, it's more than 6. Nationwide, it's probably around like 4.25 now. Now, again, as with all of these little shocks I've explained, I don't think any of them is systemic on its own. Like if you scale, oil gasoline price by nominal income, we're half of what we were in 2008 because, again, nominal GDP grew so much. So I think it's okay. But my problem is adding them all up, right? The student loan, the Californian taxes, the oil shock. Well, the shutdown has been avoided, but we'll see. And then on top of that, what happened the past week alone, where you see the 10-year yield going to 4.8% today, that's a big shock. And I think this is one of these. This might be the straw that breaks the camel's back for real estate. You see these mortgage rates, rising close to 8% now. We had a very resilient real estate market so far. You look at new house starts, you look at home builders, they're finally starting to feel the heat. So you add all that up and you're like, okay, that's, it's kind of like a boxer, who's getting like, 2 shots in the head, 2 shots in the stomach, and he starts stumbling. Now, is it going to be enough to be a recession? I don't know. I don't think I'm ready to make that call yet. You want to give the economy a lot of credit, but it certainly is a slowdown. And that kind of brings me to my main idea on the economy side, is that we went from the best of all worlds in 2023 when we had falling inflation and better than expected growth. I think going forward, we're going to have lower growth, maybe a recession, maybe not. I don't know. We'll see as we get there, and higher than expected inflation. Why higher than expected inflation? Well, I go back and I don't want to, repeat myself all the time, but those who know my work know that I believe that the new inflation target is 4%. There is no other number that works. And it's basically the fiscal reality, right? I mean, if you're going to run a budget deficit of 7% of GDP and you have trend growth of 2.5% at best, you need 4 or 5% inflation to fill up that gap. Otherwise, your debt to GDP keeps increasing because deficit is bigger than growth. You have to pay higher interest, and you get these kind of debt spirals that are so common in Latin America. So as long as we have these big deficits, we need higher inflation. We need 4.5% inflation. I would argue that we've been in that world for a long time. We just don't want to accept it. So if you want to be fancy about it, you call that PCE, core service less housing. So basically, you take from the CPI, you take the food and the oil because that jumps around. You take the goods because it's China and COVID stuff. And then you take housing out because it's messed up. So you're left with about like 20, 30% of CPI. That's been rising at 4.5%, 5% for 3 years now. Now, the way I look at it, I don't need to be that fancy. I just look at the cost of haircuts. To me, haircuts is basically that, because a haircut, there is no supply chain, there is no chips that goes into a haircut, there's no China tariff. It's just how much it costs to hire someone to get your hair. Basically, low qualified labor with a bit of rent. The cost of haircut has been rising by 5% for 3 years now. And by the way, I think it's a great thing. Hairdressers should be making more money. I think the reason we had such low growth in the 2010s is because, labor was getting screwed. The margins were going up, asset prices were going up, healthcare costs were going up, college was going up, and workers just couldn't afford stuff. And, we put in a credit card and that didn't work. And then so from a growth perspective, it's a great thing. And I think it keeps happening, by the way. I mean, you see the strikes, the UAW worker getting 40% pay raise, the UPS workers, the airline workers, the Hollywood writers. I mean, we're living in an age of labor activism that we haven't seen since, I'd say, the late 70s. So that wage price wage loop took a while, but it's on. And again, I think it's a good thing from the perspective of growth. It basically part of that idea of the Great Reset. And I'm not saying that in a conspirational way. I'm saying that we came from a world of where we could barely hit the 2% target inflation. We had 0% rate. We had very low growth, the new normal, right, in the world of Bill Gross. And now we have a new normal, if you will, where we've reset, where the Fed funds rate has already reset about 5%. Inflation has reset to 4%. Now what we see resetting is the long end, which should reset to 5% and above. And we'll figure out that's, I would argue, a better world from a growth perspective. Now, the only problem with that world is that stocks should not be trading at 20 times earnings in this world. But hold on, I forgot one last thing I wanted to mention on inflation. One reason why I believe inflation is going to come back up, first of all, it already is, right? You look at the last two CPI, it's going back up, and that's mostly because of base effect. So the peak in inflation was June 2022. So after that, inflation fell on a month-over-month basis. So now you get this base effect. Two, you get the oil shock, and it takes a couple months for high gasoline prices to kind of dribble through the CPI. And third is the healthcare cost story. I think that's someone that people miss. 10% of CPI is healthcare, and that's imputed from the profits of health insurers, which is completely messed up. And that leads the BLS to think that we have deflation in health prices. I repeat, deflation. It's actually cheaper now, supposedly, to get healthcare in the US. Now, anyone who pays a health insurance premium knows that is not the case. It's not cheaper. That's just a quirk, and that quirk will get, I think, reset in November. In my view, that needs to reset to like 5% at least. So you go from basically 5% increase on a 10% rate that adds 50 bips to the CPI. To me, that means that you're not going to go much under 3%, and we're going to settle around 4% for next year. So yeah, in that great reset world where, short end is at 5.5%, long end is getting close to 5% very rapidly. Inflation is at 4%. There's one odd man out, and it's stocks. Stocks should not be at 22 times earnings. I'm sorry. If you look at your equity risk premium, no matter how you break it, for the first time in 40 years, the earnings yield on the S&P 500 is less than the Fed funds rate. You can get 3.3% real yield on 2-year tips. I mean, to me, that's the craziest number. We went from minus 3% on the 2-year tips to 3.5%. in 18 months. And the valuation of stocks hasn't moved. I mean, that's absurd. That's a 6% move in the risk-free rate, short-term risk-free rate. So that either that means your equity risk premium is compressed like crazy, so your expected return is close to zero on stocks, or that means that stocks are just a little slow to get the memo, and they will reprice. I think that's what we're seeing right now. Some people are seeing it. It's companies themselves. If you look at buybacks, they're down 40% from the peak. If you look at buybacks ex big tech and ex energy, they're down more than 50%. And I remember 2007. Actually, that was my first job, was to make a database of buybacks in the US. And I could see them in 2007, all the corporate, boom, canceling buybacks. That was like 6 months before the drop. And yeah, it kind of makes sense. Same reason as 2007, right? I mean, why would you buy back your stock at 22 times earnings? Actually, when you borrow money at 8%, if you're like BB around investment grade, to buy back your stocks at 22 times earnings, that's stupid. That decreases EPS, and you get paid based on EPS. So companies are saying, hey, okay, fine. But that's a big number, right? Last year we had about $1 trillion in buybacks. So let's say we halve that, that's 500 billion less in equity demand. At a time when you have, the Fed balance sheet shrinking, the TGA is getting refilled. So you have a lot of drain on liquidity at the same time, and then companies are saying themselves, "Hey, I'm stepping out." So yeah, not very good for companies. So who's gonna buy stocks? Basically, people haven't been buying stocks in general. If you talk about the vast majority of stocks, as you know, it's all about the Max 7, right? And you look at the Russell, the micro cap index, so 2,000 to 3,000 cap, it's actually down for 5 years now. 5 years, secular bear market. Since 2018, micro caps are down. So really the big story has been, the Max 7, right? That's all there is. And my impression is that we filled pretty much every portfolio with the Max 7 stocks. So here I take an example from the S&P 500 value index. What is the biggest value stock in the US? It's Microsoft at 35 times earning or something stupid like that. What is the second best value stock in the US? Amazon at 100 times earnings. And then you go down the list and you see Salesforce, you see Netflix. Actually, I could see a case that Meta might have looked like a value stock earlier this year. But you're like, what's going on here? My impression, I mean, I don't want to sound conspirational, but I look at pretty much any index: quality, Microsoft; value, Microsoft; growth, Microsoft; low volatility, Microsoft; ESG, Microsoft. Seems to be that we force down the throats of pretty much every single portfolio manager, your Microsoft and your Apple, and from an index provider, it makes total sense, right? You get paid on AUM, so you don't want to underperform. So when you have like 5 stocks that make 33% of the index, you're going to cram them in every single index as you can. But to me, that just means that where is the next demand going to come from when you even force your value guys to buy stuff at 40 times earnings, right? And then the second thing that it shows is the reality, by the way, because Microsoft, S&P is not cheating. They have rules. It's very rule driven. The reason it goes into the value index is because the growth score is very low. Because if you look at the big 5 companies, the Mag 7 minus Tesla and Nvidia. Tesla and Nvidia are real growth stocks. I mean, for better or worse, the valuation is crazy, but the growth is there. But you look at the other 5, I call them the 5 imposters. The growth is very slow. For 2 years now, these guys have undergrown top line US nominal GDP. So nominal GDP has grown faster than the top lines of Microsoft, Apple, Netflix, Amazon, your big tech platforms. The earnings have been falling, and now they're barely recovering. So yeah, that growth is just no longer there. You have about 30% of the index that's no longer growing, but still trades at internet bubble-like valuations. Which kind of brings me to earnings as a major risk for the market. So for now, we had this pattern, and I'm getting tired of it. For 3 quarters in a row now, you see the blue line, The beat rate, yoo-hoo, 80% beat rate every quarter. Everybody's a hero. And then you put it in your Excel spreadsheet and you aggregate the net income and you say it's falling every quarter. Last quarter, it was down 7%. Jesus. So yeah, I'm kind of tired of beating, but losing. And my concern is that going forward, the analysts expect that this was the worst, guys. It's going to be better. Like Q3 is going to go turn positive, Q4, and then it's going to accelerate in linear fashion till the end of next year, when we'll see about 15% EPS growth. And that's going to happen on the basis of margin expansion. Margin expansion. Now, okay, your energy cost is up. Your interest cost is resetting. You borrowed all this money at 1% in 2020, 2021, and now you have it to roll it over at 7%. That's going to be a hit. Your labor costs are increasing because you have to pay your guys like 30, 40% pay increases. And at the same time, if I'm right about the US economy slowing down, the top line is shrinking. How can margins expand this way? How can we see a return to the profit margin of 2021 when basically the government was sending checks to people so they could buy stuff on Amazon and watch on Netflix? This is what analysts are forecasting. Analysts are forecasting that you will see a return to the 2021 margins. Yeah, I don't think it happens. I think, we'll see companies having to guide lower. I think that should happen this earnings season. In the same way that the last leg of the bull market was, the NVIDIA guidance. I think we'll see some, maybe NVIDIA itself, maybe another big tech company say, hey guys, I cannot make these numbers. We have to reset lower. So that brings me to my last idea, which is that what we are witnessing is an inversion of the one trade. So for the past 15 years, since 2008, you had one trade that made about 8% annually with almost no vol. That was long the US, short the rest of the world. There was always something going on in the rest of the world that, whether it was the European debt crisis, whether it's the collapse of the yen after the QQE, whether it was China messing it up, whether it was emerging market getting hammered. There was always a reason for the rest of the world to underperform. And there was always a reason for the US to outperform, share, big tech, AI. For 15 years, this was the mega trend. I would argue that this trend is actually rolling over, and you would actually see it if China was not such a big part of indices. In terms of sentiment, this is the sentiment check that I love. I love this Brazil takes off. Great job, the economy. This is 2008. This one was when the real was like 1.5 or something like that, and you had all the Brazilians who were like in buying condos in Miami and going to Disneyland in Orlando. Yeah, if you bought Brazil when supposedly Brazil took off, 15 years of pain for you. Conversely, now we see the exact opposite, right? America's astonishing economy. A recession is impossible. I mean, even I, who's been like the biggest bull on U.S. growth, I'm like, hey guys, like this is getting crazy. And conversely, of course, in China, I don't have the covers there, but you can remember that I think there was one with Xi Jinping riding a snail, I think. And then, I don't know, China is the next Japan, China is the next Lehman, whatever, which seems to be, by the way, to happen just at the time when I believe China is bottoming out. But anyway, so we have really the opposite in terms of sentiment. US can do no wrong. BRICS can only mess up, the exact opposite of 15 years ago. Now, my view is, it's not going to be that bad in the U.S. Maybe we'll see a recession. Who knows? But for now, what I'm thinking is it's going to be just a little bit less good. And if you look at the dollar smile, basically the idea is you make money in the U.S. when things are super good because everybody wants to buy the NASDAQ and the next IPO, or when things are super bad because, the U.S. is the biggest navy and they can pretty much bomb any country in the world, so you want to buy the treasuries. In the middle, this is when, foreign assets do better. And I think that's precisely where we're going to go. We're going to go from extraordinary growth, that 5% GDP now number, to, I don't know, 0.5, 1. I don't know where it's going to be. Somewhere in that range in 2024, bar an accident. This is typically when foreign markets do better. I think one reason for that trade is simply rising rates. Keep in mind that the U.S. is the world largest debtor in the world, right? We run deficits. We've run deficits in the mid 70s of close to 5% of GDP now. So if you run a deficit, that means foreigners are constantly buying your assets. So you're net that. Now, when rates go down, it's great. It's like you have a big credit card balance, but your monthly payment keeps dropping because the rate's dropping. As rates go up, you have the opposite effect. So the net investment position of the U.S. is minus 16 trillion. Let's say you got to pay 5% from zero on top of that. That's almost $1 trillion that you have to pay to foreigners. And that gets added to the current account deficit. So I think something that we'll start talking about soon is going to be the twin deficits, government deficit plus current account deficit. As a share of global GDP, it is higher now than it was in 2004 when everybody was freaking out about the twin deficits. So we will have, basically U.S. assets will have to make themselves cheaper in order to attract this flow from foreigners to offset the fact that the U.S. is paying more and more and more to service foreign-held U.S. assets. So yeah, I would say that, you could see that this is happening already. If it were not for China, if you look at, global EM assets have not done well, but that's because of China. But if you look at the past year, the best performing region, actually Europe, despite the Russian invasion, despite, like Germany being a complete mess, Europe has been the best performing region. Second best performing region, Japan. Even in dollar terms, I mean, you look in yen terms, the Nikkei just goes up every day. And even in dollar terms, you made more money. LATAM has been quite strong. And really the weakness has been on the kind of Asia Pac region, which I believe may be bottoming. Now, if we look at the currency side, hey, these are things you don't see in a year of higher U.S. growth and a very hawkish Fed. What is your best performing currency this year? The peso, the Argentine, the Colombian, the Mexican, the peso, just long peso. Doesn't matter what peso it is. I actually have a report coming out tomorrow on the super peso. I mean, it's amazing. You go to Mexico City, I mean, it's booming. You go to Monterrey, you have cranes. I mean, Monterrey looks like China 20 years ago. And by the way, this list of outperforming currencies, you even have the Indian rupee, the Indonesian rupiah in there. It's pretty much the same as 2022, which, again, I think is very important. You had a huge yield shock in the U.S. We raised rate from 0 to 5.25. We're seeing the long end, go up, higher for longer, no recession in the U.S. And these are the currencies that are doing better. You go long the Brazilian real and the Indonesian rupiah. I mean, this was the same list in 2022. So when you see something that really should not be happening, that is happening, and that's been confirmed now for 2 years, I think that tells you something very deep and profound, which is, yes, the market leadership is shifting away from the US to the rest of the world. Now, China is still a question mark. I think China is bottoming out, but time will tell. But generally, that call that I've had on EM ex China, is where you want to be. Now, of course, like things look a little stretched. I mean, I mentioned that about the peso. I mean, you look at, peso at like 17 to the dollar. It's like, yeah, it's probably hurting a little bit. But most of these drivers are still there. The carry is still there. The deficits are not that big. You have the huge benefit of being to buy Russian oil and grain in your own currency, which for a country like India or Indonesia is a huge deal. So I think this is the early stage of a secular bull market for international assets. And one thing that supports that, the idea that it's going to be secular, is the valuations. If you look at the valuation gap between US and the rest of the world, it's never been that big. And it's not just a tech story. Okay, yes, the US is obviously driven up because of the Mag 7 stocks, which don't really have an equivalent abroad. Although I would argue that, you look at your big tech in China, like your Baidu, your Tencent, Alibaba. I mean, Alibaba is trading below the IPO price. So anyway, but even on a sector neutral basis, that discount is very big. Yeah, it makes sense that, it's going to take more than a couple of years to revert that. And then if we look within countries, if you look between various asset classes, you see the same picture. In the US, I would argue that cash is extremely attractive. I've been staying short on the duration side all year long. Now, of course, as we see yields rise in the long end, I'm willing to extend that. I'm looking at a 5-year tips. I'm getting 2.5% risk free. Of course, 2-year is 3.3, so it's even better. But anyway, the point is your fixed income is very attractive in the US. Your equities are not. 20 times earnings. Your equity risk premium is 0 in the US. Now you compare that to other regions like Japan, like Europe, where the yields haven't risen all that much, and the valuation, you see stocks trading at 10 times earnings. Well, that means your equity risk premium is around 8%. Now, of course, some of that's going to go away if we see rates go up, but I don't think rates are going to go up all that much more in Europe, for example. So yeah. And then the last thing I'll mention on this chart, you see that Latin America has a very negative equity risk premium. I would argue this is because the bonds are too cheap in LATAM, not the stocks too expensive. So I think if we do this chart in 6 months after a couple of cuts in Brazil, maybe Mexico, you'll see that the last country on that ERP is going to be the US, which kind of supports again my view that we've entered a new era of outperformance by non-US assets. All right, I think we're getting close to the 40 minutes, so I wanted to leave about 15 minutes for Q&A. See what we have here.
Great. No, I think we do have some really interesting questions. There was a particular question that on JOLTS data today. In addition to, has the unemployment rate hit bottom? Does the Fed need to see negative payroll prints before thinking of cutting rates? And that could be two-pronged where, we saw JOLTS data kind of uptick today. Do you see that trend, going higher in addition to, unemployment rate, what's going on with that?
Yeah, I think it's going to confuse people for a lot of time, and including the Fed. The JOLTS data, I love the JOLTS data because it tells my story, right? It's like, oh, wow, you get see 1.6 open jobs per worker. At the same time, you have all these methodology paper that tells you that maybe it's not that good anymore. And I still think the labor market is tight, man. And just anecdotally, I'm trying to get a roofer to come here. No way to get a roofer. You still see the so I kind of buy the idea that the job market's tight. I also look at Europe, and it's goddamn awful in Europe. You have shrinking GDP, industrial outputs collapsing. We don't know if we're going to be able to keep the German factories running this winter. And your unemployment rate's like 3%. Even in France, it's like the unemployment rate's falling. So I think the tightness of the labor market is a completely different story to some extent. The relation between the economic growth and the labor market is very different from what it was. Before, I think you had a much higher sensitivity of labor to growth. And that's because of demography. That's because of the rise of the gig economy, all these things that I've talked about. And I think that the question was hinting to the idea that, the Fed is going to wait to look at the unemployment rate to turn before the cuts. Man, if they're going to do that, they're going to wait for a long time. And then that would be a higher for longer argument. I kind of agree the Fed kind of boxed itself into that corner by messing up with the transitory story and talking about the labor market. If you're going to look at the most lagging indicator at the best of time, right? Employment always lags, right? This is first you see profits, stock prices, then profits, then employment. That's a normal cycle. I think you're just at stage one here, stock prices. Anyway, so that means they're going to stay. They will probably, my guess is they're going to stay at 5% for still longer than the market thinks, if that's what they want to do, unless there's something else that happens, like you see something else breaks and then they'll do something to fix it. But if the economy, nothing breaks in financial markets and they're waiting for the labor market to turn, good luck.
high USD, high oil, high US yield. Do you see Asian financial contagion like in the 90s?
Not really, because that high oil is just our oil. I mean, if you get to buy your oil in rupee at a 30% discount to a shady, Azerbaijani intermediary, which seems to be happening a lot, you're actually having much cheaper oil. I mean, just the ability to switch from dollars to rupee that you can print is huge. So no, I don't see the Asian currencies being battered down. I think, and then in terms of the yields, they're not spreading. You see the China PBOC actually cutting rates, and I think for the Asian regions, what matters more is what the PBOC does. So I don't think we see a repeat of the Asian financial crisis. I mean, in some way, that would be kind of like to some extent, I think that's what baked in the bullish case is some sort of a repeat of what happened in 1998. In 1998, we had the Asian financial crisis, the Asian currencies get hammered, oil prices as a result get hammered, and then that allows the Fed to cut rates, even though it didn't need to. Growth was still strong in the U.S., but inflation starts to fall, the Fed cuts rate. That's kind of what's implied, I think, in the stock markets. Like growth is going to stay strong, inflation is going to fall, then the Fed's hand is going to be free, and they're going to be able to cut rate like 3-4 times next year. I don't see that happen.
Okay, great. Now back to US. I have a question. What are your thoughts on long-term tips? And I'd like to add, what are your thoughts on the 10-year yield?
Oh, long-term tips. Yeah, I like it. My concern is, so far I preferred the short-term tips because you get a better real yield, right? I mean, if you look at your tips curve, it's more like 3.5 on the 2-year, then it's 2.5 at 5, and then it's 2% at 10. So you get more bang for your money in the short end. I also worry a bit that we'll see real rates go back up, and that's kind of linked to the second question. I think the supply and demand picture on the treasuries is pretty goddamn awful, and maybe we're not done yet. So I would still keep it short, but I would lengthen it. Maybe I mean the barbell thing. This is something that people who want to sound like they're with the barbell portfolio. Yeah, buy cheap stock at cheap quality stocks and barbell portfolios. But I actually believe that the barbell idea is like, because I do worry that we'll see this kind of second wave of inflation. At some point, we'll have to kind of like, okay, Powell will be, hey, it's too hard to go to 2%. We find at 4%. And then I think you really want to have some long-term inflation protection in your portfolio. So stay short, but yeah, maybe add a little bit to 5-10 year tips. Now on 10-year yields, this is something we wrote about. We had a report a month ago called the Liz Truss moment in the U.S. Treasury market. Basically said, hey, we could go to 5% in a week. And I know I sounded crazy back then, but yeah, we're almost there. And then it's supply and demand at the end of the day. It's all the things we talked about, the deficit coming in bigger. Yellen had been able to kind of put everything on the front end, empty the TGA. We used all the EM tricks in the book, give it to the banks, and then refi the bank with a Fed balance sheet, and then issue short-term debt. And I mean, this is like accounting gimmicks you'd expect to see in Brazil. But now it's like, yeah, you got to stay on the long end, and there's not that many people willing to buy. Your banks are over, they have way more long-term treasuries than they can handle. CSVB. Your foreigners are like, no, thank you. I'll skip this one, especially since you can steal my treasuries if you don't like me anymore. Europeans are like, hey guys, we need hundreds of billions of dollars to buy weapons and gas, so we can do it. Even the Japanese are starting to be like, oh Jesus, like am I really going to like, how low do I want the yen to go? Like am I gonna keep selling yen, buying dollar treasury? I mean, it's like 150 or whatever. So yeah, there is a squeeze on the long end. Now you can, I mean, if you believe the Fed's models, you can make a case that we're getting close to fair value. I would say it's more 5%, but yeah, if you get to 5%, based on my view of 4% inflation, 1%, I mean, you still don't have much of a term premium, but it's certainly a lot better than it was 3. If you believe the R star, that thing that doesn't exist that people keep talking about, I think they have it at 2.5, the Fed, right, in the latest SEP. So 2.5% is the neutral rate according to the Fed. You add a normal term premium of maybe 1.5, I get you to 4%. So there is a fair value case to be made, but I wouldn't chase it there. I think ultimately the bond market doesn't care about your econometric model, doesn't care about your PhD or your estimation of R star. The bond market cares about supply and demand, and there's more supply and less demand.
Great. No, thank you so much. Now to move on, what are your thoughts on growth in countries like India, which are importers of oil? Returns, which can be what kind of returns can be expected from them?
Well, I would argue that the oil shock is asymmetric. So the oil shock for especially for basically breaking in the world into 3 categories. Okay, you get your Europe, US, Asia. Europe is the one that's getting the hit because we used to get like 40% of our energy from Russia, and we decided we don't want it anymore. I mean, we're still buying it. We're just paying way more than we buy Indian oil now in Europe. Somehow India's foreign oil, guys, is great. It's got a Russian accent to it, but basically the Russian oil gets refined in India and sold as Indian oil to Europe. But anyway, and we pay a premium for it, and the Indians are collecting that premium, by the way. And in Europe, obviously we had the Energiewende in Germany, the closing of the nuclear plants in France, worst possible time. We're doing the energy transition. I mean, you can't turn off Russian oil, turn off nuclear. I mean, there's a gap, right? And what's been filling the gap is coal, which, by the way, a lot of that coal comes from India or Indonesia. So Europe is net loser from this. US, you add US and Canada, you pretty much have energy self-sufficiency. So I'm not too worried about oil in the US. It's just a transfer basically from New York to Texas, from Illinois to North Dakota. So there's regional implication, but as a whole, the U.S. doesn't care. If anything, the U.S. gets to sell its LNG more to Europe at a big premium. So U.S. is fine, neither good nor bad. That's the the Polonius in Shakespeare. Neither borrow nor lender be. And then we turn to East Asia, and I think these are the net winners because they get the Russian oil cheaper and in their own currency. So it doesn't matter if you can pay in your own currency. It doesn't matter what the price is because you print the thing you buy it with. So you could argue the cost of a barrel of oil from India is 0 now because they buy it in rupee. So I think this is usually growth positive. In general, you look at demography. Obviously, India has by far the best pyramid of any other country. I think what you see is a infrastructure boom. There's not a day where I'm not reading about building a new port to link Russia and then Pakistan and a new highway. And another story that I think is underappreciated is the peace deal between Iran and Saudi. She basically came in and said, "Hey guys, shake hands and then let's get the photo up." Now, of course, MBS was really happy to do it to spite the US. Like this was a huge payback moment. I'm going to sign the biggest peace agreement in, I would argue, like, I mean, 50 years. This is very important. And I'm going to have Xi Jinping be the broker instead of Joe Biden. So now you have peace between, Saudi and Iran. That means you need less dollars. You don't need to buy all these stupid weapons. You can start, building stuff. You see joint Navy exercise between Saudi and Iran, which is kind of we've never seen before. So that would argue for this idea of the monsoon crescent, basically the Indian Ocean. You go an arch that stretch from Bali to Cape Town. So you get your Bangladesh, India, Pakistan, Iran, Saudi Arabia, and East Africa. This is the fastest growing economies in the world. You got the human labor, the human potential with India, Pakistan, Bangladesh, huge middle classes, growing, educated. You get the capital from the Gulf-rich country. You get the resources from Africa. And if we see kind of globalization move down there, you could see an era of growth that would rival what was happening in China and East Asia in the 2000s. I mean, it's not clear that everything will play right, but to me, it's the most interesting geopolitical story is globalization moving to the Indian Ocean.
Great. And I think we're running kind of short on time, so I'm going to go in for one more question. Under what scenario would you turn bullish on stocks? You spoke about valuation a ton today, Amazon trading 100 times earnings. And to follow that up, what would be the fair value of the S&P that you would see? I figured we could end on a good note on there.
So for me to turn bullish on stocks, I think I would look at technicals, although at this point there's so much damage to the chart that obviously we crack down that floor. We're getting close to 100-day moving average now. Maybe we get a bounce there. I want to see broadening. I want to see the small caps outperform the large caps. I want to see good closes. I don't want to see these kind of late hour massacres. So that would be the technical signs to me that maybe it's time to get back in. The fundamental side that would drive that would be basically you need to see relief from what's killing the stock market right now, which is bond yields, high oil prices, and that's pretty much what's killing the stock market right now. And then that will mean your profits get better. So you need to see like something like a cathartic sell-off. I think we sell off to the 200-day moving average. You see treasury yields collapse. Like people, I'm finally gonna buy treasuries. Oil prices go down significantly, and then maybe you have a bullish case. I don't believe that's really likely. It's of course anything's possible. Maybe Russia and Ukraine say, hey, we figured it out, guys, and we're gonna turn the tabs back on, and Saudi Arabia and Joe Biden become friend again, and we drop the tariffs on China. Sure. That would be kind of like 98 type of scenario. I don't really see it, especially not in election year. So, that leads me with your next question. What's the right target? I think a proper PE when you have like 5% 10-year yield is 15. So what's your EPS? 220, something like that, I think, for next year. Maybe a bit less. I mean, but basically you slap a 15, 16 times that gets you to, 3,600-ish, would be my guess. So that's that. I guess what I'm saying is we'll have a proper bear market, and this is what's happening. Yeah, your EPS right now is 220. So slap whatever 16 times that is, I think is pretty much what fair value would be.
Great. And I think we are getting close to the time. So I just want to thank you for your presentation today. And thank you for everyone that joined us today. As a quick reminder, we do hold these macro updates quarterly, but please look out for an invite from your StoneX representative. Vincent publishes his research on a weekly basis as well on our market intelligence platform. I want to thank you again, and I hope to see you guys next time. Bye.
Bye. Thank you, everyone.